So, what if I told you the company quietly running the AI revolution isn't actually designing chips?
Right. And the company dominating global e-commerce isn't moving packages either.
Exactly. I mean, we often rely on these massive, slow-moving government reports to, gauge the global economy.
Yeah.
But it's like trying to check a patient's health by looking at a photograph taken 6 months ago. You get a general idea of what they look like, but,
But you have no clue how their heart is beating today.
right, you just don't know.
Because macroeconomic data is, by definition, retrospective. We naturally crave certainty. I mean, we all do. But by the time the Bureau of Labor Statistics tells you what happened in manufacturing, the
Yeah.
industry has already moved on.
Yeah, the data just tells you where we were, not where we are.
Exactly.
Which is why getting your hands on a fresh corporate earnings report, especially from a company that builds the literal machinery of the economy, turns that static photograph into like a live EKG.
Oh, absolutely.
You are suddenly looking at the real-time vital signs of global industry. So today, we're unpacking a highly revealing set of vital signs for you. We're looking at the Q2 fiscal 2026 earnings presentation from Rockwell Automation.
Flat off the presses today, May 5th, coming 26.
Right. And the mission for this deep dive isn't to just, read a spreadsheet out loud to you. We want to decode what these numbers actually reveal about the underlying mechanics of global manufacturing and tech right now.
And looking at Rockwell is honestly the perfect lens for this. I mean, they don't manufacture consumer goods.
No.
They engineer the industrial automation systems, the predictive software, and the intelligent devices that other companies rely on to manufacture everything else.
They're essentially building the central nervous system for the factory floor.
That's a great way to put it. The data in this deck is a direct reflection of capital expenditure confidence across almost every major sector.
Okay, let's unpack this because I want to get right into those numbers. The top line and bottom line beats are just aggressive.
Yeah, they really are.
I mean, reported sales for the quarter hit $2.239 billion. That's a 12% increase year over year.
Which is huge.
Right. And the deck breaks this down into 9% organic growth, with currency translation adding about 3 points of tailwind. But the bottom line is where the numbers really start to leap off the page. Adjusted EPS came in at $3.30.
Go.
That's a 32% jump year over year. And their enterprise operating margin hit 22.5%, which is a massive 350 basis point expansion from the previous year.
Well, what's fascinating here is the magnitude of that margin expansion.
Yeah.
That is the critical signal.
Yeah.
A 350 basis point jump in pure operating margin for a multi-billion-dollar industrial incumbent in a single year.
It's crazy.
Is highly unusual. It indicates that customer demand isn't just, isolated to a localized sector or some temporary panic buying spree.
Right.
We're looking at a broadening demand curve across a massive industrial base.
Yeah.
It's completely defying the macro headwinds that usually compress margins in heavy industry.
Okay, but I need to push back on that margin expansion for a second.
Sure.
Because a 3.5% bump in margin in this labor market, the deck explicitly acknowledges they are facing higher compensation costs.
They are, yeah.
So if they're paying their engineers and technicians more, how much of this margin expansion is simply aggressive pricing? I mean, are they just leaning on their pricing power and squeezing their customers, or is there actual operational leverage happening under the hood?
That's a really fair question. But the data points directly to operational leverage, though, pricing power certainly plays a role.
Okay.
The deck attributes this expansion to higher sales volume and what they term positive price cost inclusive of productivity.
Corporate phrasing. Gotta love it.
Right. But the mechanism behind that phrasing is vital to understand. Over the last few years, industrial companies pushed through significant price increases to combat inflation.
Right. Everyone did.
Exactly. But now, raw material costs and supply chain friction like paying exorbitant expedite fees for microchips have stabilized.
Oh, I see. So the input costs fall back to earth, but they maintain the higher contract pricing they established last year.
Bingo. The spread between the two widens, and that drops straight to the bottom line. That's the price cost element.
Got it. And the productivity.
The productivity element comes from their own internal automation. Plus, when your organic volume grows by 9%, your fixed overhead, like the cost of running your own factories, your administrative footprint, is absorbed over a much larger base of units.
So they're achieving higher throughput without a proportional increase in fixed costs.
Exactly. That is classic operating leverage.
Wow. Okay, seeing that level of volume growth naturally begs the question of where this capital is actually flowing from. And the geographic breakdown in the presentation shows North America acting as the primary engine.
Unsurprisingly, yeah.
Right, it represents 63% of their total sales and grew 9% organically. But what really stands out to me is the uniformity of it all. Asia Pacific grew 10% organically, and EMEA grew 9%.
The alignment of those growth rates across three major global theaters tells a very specific story about supply chains.
How's
Well, we aren't just looking at a localized North American nearshoring trend anymore. The push for automation has become a global imperative.
all right.
Companies in Europe and Asia are facing the exact same demographic cliffs and labor shortages that the U.S. is facing.
That makes sense. The only countertrend I saw was Latin America, which contracted by 1%, but it only makes up roughly 6% of their total revenue pie anyway.
Right, it's a minor piece of the puzzle.
So it's one thing to see this growth uniformly distributed across the map, but the real story is what industries are actually driving it.
Yes, the segment breakdown.
Exactly. Looking at the breakdown between discrete, hybrid, and process manufacturing, the growth in the discrete segment is just explosive.
It really is.
E-commerce and warehouse automation grew by roughly 30%. Semiconductors grew in the high teens, and automotive was up in the mid-teens.
I mean, the e-commerce figure alone is staggering when you consider the sheer scale of those operations today. We aren't talking about simple conveyor belts anymore.
Right. Here's where it gets really interesting for me because it changes how you view their market position. It sounds like Rockwell isn't just riding one specific tech wave. They are the people selling the pickaxes for the modern digital gold rush.
I love that analogy.
Because whether that's building the chips or moving the boxes, they're involved. A modern micro-fulfillment center has thousands of autonomous mobile robots moving simultaneously at high speeds. Rockwell provides the software and the localized controllers that calculate those physics in real time to prevent, like, $1 million collision.
The semiconductor growth illustrates that perfectly too. A modern semiconductor fab operating at sub-nanometer precision has absolute zero tolerance for vibration.
None at all.
Right? No vibration, no power fluctuation, no atmospheric contamination. The automation required in those clean rooms is incredibly complex.
Yeah, I can only imagine.
If a single wafer batch is ruined by a microsecond delay in a robotic transfer, it literally costs the manufacturer millions of dollars. Fabs are buying Rockwell systems because they require an industrial-grade reliability that standard enterprise tech just cannot deliver.
But wait, semiconductor fabs and e-commerce build-outs are historically highly cyclical, aren't they?
They are, yes, very boom and bust.
So companies build massive capacity and then they stop buying for 3 years. Doesn't heavily indexing into those hyper-growth discrete sectors expose Rockwell to a massive cyclical cliff?
If they were only exposed to discrete manufacturing, yes, absolutely. But the presentation highlights how their hybrid and process segments act as a ballast against that cyclicality.
A ballast. Okay.
Right, look at food and beverage, up high single digits. Energy and chemicals are up mid-single digits. Mining is flat, while life sciences and home care are up low single digits.
The bedrock industries.
Exactly.
The things society consumes regardless of the interest rate environment or, the latest AI chip cycle.
Yep. The portfolio construction here is highly intentional. The hypergrowth in discrete tech infrastructure provides the massive margin upside and top-line acceleration.
Right.
Meanwhile, the continuous process industries, where you can't simply shut down an oil refinery or a food packaging plant without catastrophic costs, provide an incredibly durable revenue floor.
That durability becomes even more apparent when we look at how these companies are actually purchasing from Rockwell. Moving from who is buying to what they are buying, the segment reporting reveals a structural shift in their financial identity.
Yes, the software pivot.
Right. They break revenue into 3 buckets: intelligent devices, software and control, and lifecycle services. Intelligent devices generated just over $1 billion in sales with a 20.9% margin. Lifecycle services generated $547 million at a 14.6% margin.
But then there's the third bucket.
Yeah, software and control brought in $684 million with an operating margin of 34.9%.
The critical data point in that section is the velocity of the software margin.
Yeah.
It didn't just grow sales by 20%. That margin expanded by 480 basis points year over year.
Okay, for you listening, I have to ask directly, is software and control basically acting like the brain of the operation, while intelligent devices are the muscles? And why is the brain so much more profitable?
That's a perfect way to conceptualize it. Once the software is built, Selling another license or subscription costs very little,
Right.
hence the near 35% margin. But I know you're probably thinking,
Well, I have to challenge that 34.9% margin figure, honestly.
I thought you might.
Because if Rockwell is successfully pivoting to an industrial SaaS model, why is the margin only 35%? I mean, pure play Silicon Valley enterprise software companies routinely post 70% or 80% gross
Oh,
margins.
absolutely they do.
Is Rockwell carrying massive legacy costs in that segment, or is industrial software just fundamentally different?
It is fundamentally different. Industrial software operates under vastly different constraints than standard enterprise SaaS. When a tech company sells CRM software, it lives entirely in the cloud and interacts with human data entry.
Right, typing on keyboards.
Exactly. But when Rockwell sells a digital twin simulation or a predictive maintenance algorithm, that code have to interface seamlessly with massive physical kinetic energy.
Oh, wow.
It requires custom integration layers, edge computing hardware on the factory floor to eliminate latency, because you can't have a millisecond delay when dealing with heavy machinery and field engineers who understand fluid dynamics and mechanical stress.
So it's way more involved.
The cost of deploying and maintaining software that bridges the digital and physical worlds is just fundamentally higher.
The friction of the physical world eats into the margin.
It does, yes. But here's the flip side. That same physical friction creates a massive barrier to entry,
Ah, a moat.
a huge moat.
Yeah.
A pure software startup cannot easily replicate the decades of physical machine data and domain expertise Rockwell possesses. The 480 basis point margin expansion shows they are successfully scaling this software across their massive installed base.
Right, because once they build a machine learning model that can predict a motor failure in a chemical plant, deploying that model to the next 100 chemical plants requires significantly less marginal capital.
Exactly. And if we connect this to the bigger picture, the presentation leans heavily into the recurring nature of this revenue. Total annual recurring revenue, or ARR, is up 6%, with software ARR specifically up in the high single digits.
Which fundamentally changes the relationship between the manufacturer and the supplier. I mean, historically, a plant manager bought a $500,000 piece of equipment, capitalized it, and didn't call the supplier again until it physically broke 10 years later.
Right, the traditional CapEx model. But the push for ARR means Rockwell is transitioning to a more predictable, resilient, subscription-like revenue model. Customers aren't just buying hardware, they're subscribing to continuous uptime.
They're paying for peace of mind.
Exactly. They are paying monthly or annually for cloud-based analytics that monitor vibration frequencies, thermal output, and energy consumption. This model smooths out Rockwell's revenue curves, making them far less reliant on massive one-off capital expenditure cycles.
So the economics of this transition are clearly working, which makes a specific strategic decision buried later in the deck highly counterintuitive to me.
The Sensia divestiture.
Yes. Despite record margins and accelerating sales, the presentation details the dissolution of the Sensia joint venture in the second half of fiscal 2026. This divestiture already dragged down Q2 sales by an estimated $49 million, mostly hitting the lifecycle services segment.
Right.
So what does this all mean? Why would a company actively shed $49 million in quarterly revenue when the macro environment is performing so well?
It seems backwards, right? But evaluating divestitures requires critical thinking. You have to look past raw revenue and focus on capital allocation and margin gravity.
Unpack that for me.
Sensia was a joint venture, specifically focused on digital oil field automation. We already saw in the segment data that the process industries, like energy, are growing at a much slower mid-single-digit rate.
Right, you mentioned that earlier.
More importantly, joint ventures are inherently complex. They require shared governance, distinct sales channels, and they often dilute management focus.
And looking at the segment margins, Lifecycle Services, which absorbed the bulk of this Sensia hit, operates at a 14.6% margin. That is a massive drag compared to the near 35% margin they are printing in software and control.
Exactly. Shedding Sensia is a textbook margin accretive maneuver. By cutting loose a lower margin, slower growing, structurally complex asset, management frees up engineering talent, capital, and executive bandwidth.
So they can double down on the winners.
Yes. They redirect those resources entirely into the high-velocity discrete markets and the high-margin software stack.
The conviction behind that move is really obvious when you look at their updated full-year outlook. Even after factoring in the lost revenue from Sensia, management raised their guidance across the board.
That's the ultimate show of confidence.
Right. They boost the reported sales growth range to between 5% and 9%. They raised their enterprise operating margin expectation to approximately 21.5%. and they increased their adjusted EPS range to $12.50 to $13.10, which represents a 22% increase year over year at the midpoint.
But you know, the most revealing metric in their forward-looking guidance is their free cash flow conversion.
Oh, totally.
The deck highlights an expectation of approximately 100% free cash flow conversion for the year. We already saw a glimpse of this in Q2, where free cash flow jumped from $171 million last year to $275 million this year.
For you listening, if you are analyzing corporate health, 100% free cash flow conversion is the ultimate litmus test. It means that for every dollar of net income reported on the income statement, an actual tangible dollar of cash is entering the corporate bank account.
Yep. You can manipulate earnings per share with accounting adjustments, but you absolutely cannot fake free cash flow.
So how are they generating that level of pure cash efficiency?
It comes down to working capital management. During the peak of the supply chain crisis in 2023 and 2024, industrial companies were forced to hoard inventory.
Right, the just-in-case model instead of just-in-time.
Exactly. They bought massive amounts of raw materials and subcomponents just to ensure they could actually deliver finished goods. That trapped billions of dollars in working capital.
I see.
What you are seeing now in that 100% conversion rate is the great unwinding of that inventory buffer. As supply chains normalize, Rockwell is fulfilling orders from existing stock, dramatically reducing their inventory footprint and turning that trapped capital back into liquid cash.
It just demonstrates absolute operational control. They are taking the short-term revenue hit of a divestiture because the underlying engine of their core business is generating cash at peak efficiency.
Absolutely.
Well, look, if you are trying to make sense of the macroeconomic climate right now, Rockwell Automation's Q2 FY26 presentation is incredibly clarifying. This isn't just a story about a legacy company selling more factory parts or steel actuators.
Sure, not at all.
We are watching an industrial hardware incumbent successfully execute the transition into a high-margin software and recurring revenue ecosystem. They're achieving massive profit expansion by optimizing their own internal operations, unwinding historical supply chain inefficiencies, and aggressively capturing the massive capital flowing into semiconductor fabs and e-commerce infrastructure.
They're essentially proving that the digital economy is entirely reliant on the physical economy to function.
Yes, and they are writing the code that synchronizes the two.
It's true. The transition from hardware to software fundamentally alters the industrial landscape. And honestly, this raises an essential question for you to consider long after this deep dive ends.
What's that?
Well, we established that earnings reports are the vital signs of the economy. But look at where the lifeblood of this specific company is actually flowing. It's moving away from one-off metal equipment and into continuous predictive software and cloud analytics. If a century-old industrial giant is now deriving its most explosive margin expansion from code rather than physical machinery, what does the factory of the future actually represent? Is it still a physical place filled with loud, distinct machines? Or is the factory of tomorrow, at its core, just a massive physical server rack controlled entirely by overlapping layers of predictive algorithms?
Man, that reframes the entire concept of manufacturing. Something to definitely think about. Until next time.